So I think we can start. Okay, so good morning everyone and welcome to the second day of the conference, The Futures of Money. Today will be mostly dedicated to crypto and DeFi, and we have the honor to start today's session with Simon Mayer from University of Chicago, talking us about money creation in decentralized finance.
So this paper is about stablecoins, and the motivation for this paper is essentially that in 2008 we have seen the rise of Bitcoin with the promise to be a decentralized medium of exchange. But as we also know, Bitcoin and related cryptocurrencies have a very high price volatility, which clearly limits this function. A more recent phenomenon is the rise of decentralized finance. And as the name says, decentralized finance is essentially finance without an intermediary, and offers some blockchain-based and decentralized alternatives to banking, brokerage, and decentralized exchanges, for instance. And with the rise of decentralized finance, there's also growing demand for blockchain-based safe assets, so-called stablecoins. And the following graph nicely illustrates this. The graph is a bit outdated, I apologize for that, but the other two panels essentially depict a measure of decentralized finance activity. It's measured at total value locked here. So you see that during 2021, essentially, decentralized finance activity really has spiked. And simultaneous to that, we have also seen the market value of major stablecoins grow at similar pace. The crypto market has crashed, so the previous graph was clearly outdated, but the stablecoin market has stayed remarkably strong. I looked up the market cap just today, and it's about 150 billion US dollars. So the market cap of stablecoins remained quite high. So there was also some flight to safety, which could essentially motivate them. What is a stablecoin? A stablecoin is essentially a cryptocurrency which is pegged to the reference unit. In most cases, this is the US dollar. And stablecoins are offered by different entities. In many cases, it's like specialized stablecoin providers who do not conduct any other businesses. Think of MakerDAO issuing DAI. Think of Tether Limited issuing Tether. In addition to that, we have also like well-established payment providers, financial service providers such as PayPal and JP Morgan also venturing into stablecoin issuance. So the crucial question is, how do stablecoins essentially achieve stability or maintain their peg? And the most successful stablecoins essentially rely on some reserve or collateral-based mechanisms, which essentially allow the stablecoin issuer to conduct open market operations. In a sense, when the price of the stablecoin dips below the peg, you use the reserves to buy back the stablecoins to drive up the price. And in many cases, these stablecoins are backed by risky reserves. Think of Tether, which is, we don't know what it's backed, but it's like to a large extent probably backed by commercial papers of unknown quality. Next to that, we have also so-called algorithmic stablecoins, which employ algorithmic stability mechanisms. It's just an excuse in most of the cases to hold less reserves or riskier reserves. And in this space, we have like witnessed drastic failures. Last year, the Iron Finance bank run, and like more recently, Terra, which you have probably all heard of. What do we do in this paper? This paper is not only about stablecoin, it's much broader than that. It's essentially a unifying model of stable or safe asset creation. Why do we develop such a model? Well, the first aim to write with the model is essentially to have some normative implications regarding the optimal strategies and the implementation of safe asset creation. In particular, we characterize the optimal open market operations of the issuer, and we essentially derive a bunch of strategies which turn out to be optimal, such as having targeted price bands and soft and hard pegs for the stable asset. The main application of this paper, and where it originally started, is stablecoins. And with our framework, we can essentially assess the stability, or put differently, the fragility of stablecoin initiatives we observe in practice. And more normatively, we essentially propose some optimal implementation for stablecoins, which is quite be useful for practitioners. And we also use our model to essentially derive some implications for regulation of stablecoins, and that's contributing therefore to ongoing policy debates. There's alternative applications, and I see stablecoin management pretty much analogious to the task of a central bank maintaining price stability via open market operations or reserve management. Not all central banks would be applicable. The model would not apply to all types of central banks, but to some. And then it's like similar task to a stablecoin. The stablecoin would like to maintain a peg, while the central bank would like to maintain a price stability, or in some cases, like say the Central Bank of Hong Kong, they also would like to maintain a peg. And there's also other applications. So let me, yes?
These are two different things, right? You're thinking about a central bank trying to maintain a price level, low inflation,
Yes.
like US or Europe, versus central banks like Argentina
Yeah.
or Hong Kong trying to maintain a peg. I mean, I thought when a peg strikes me as very analog, like the price level, but you're going to talk about...
Price level, I would see a peg to a numeraire unit. That's how I would interpret price stability in that sense, broadly. Yeah, but it's a good point.
Yeah. Okay. Well, maybe...
Okay, let me go ahead with the model and let's stick for now to the stablecoin application. So in our model, we have one monopolistic stablecoin issuer, and the stablecoin issuer is financially constrained in the sense that it does not have deep pockets and they cannot always raise new equity. In other words, equity issuance is costly. The stablecoins the issuer offers have some convenience yield and are therefore bought by risk-averse users. Users are risk-averse, meaning that they value price stability. So that gives rise to offering some stable asset or stable coin. The stablecoin issuer is self-interested, maximizes its equity value, and in order to do so, dynamically manages its reserve assets to maintain price stability, the user fees it levies for stablecoin buyers, and the stablecoin supply, notably via open market operations, that is by issuing new stablecoins, i.e. minting new stablecoins or buying back stablecoins. And essentially one key result of the paper is that the whole equilibrium or all equilibrium quantities, and in particular the stability of the stablecoin system, can be fully characterized by one state variable, namely the stablecoin issuer's excess reserves. The excess reserves are the difference between the reserve assets of the stablecoin issuer in dollar terms minus the value of outstanding stablecoins in dollars. So the stablecoin should be pegged to $1. And when these excess reserves are large, the stablecoin system undergoes a virtuous cycle. Under these circumstances, there is no price volatility and the price is stable at its peg. Under these circumstances, because the users of the stablecoin value price stability, there's a high demand for stablecoins and the stablecoin issuer earns a lot of revenues, which essentially helps the stablecoin issuer to further grow its reserves. And as the reserves grow, the stability of the stablecoin improves further, and so on and so on. And this leads then to a very stable outcome, and the stability can persist for a very long time. On the other hand, when there are negative shocks to the issuer's reserves, and the excess reserves C are low, then there's a vicious cycle. Under these circumstances, the price deviates from the peg, and in particular falls below the peg, and there is some price volatilities. Yeah? They are risky. The reserves are risky, otherwise there's not much. Indeed, that's a good point. I should have mentioned it.
I thought the notion of stablecoins with reserves should be safe.
That would be one, so you could implement a stablecoin with fully safe reserve backing. It comes at one disadvantage, it would be kind of inefficient, you transforming safe assets into safe assets. The more interesting part is to transforming kind of risky assets into safe assets. But I agree with your point, probably that's where regulation might be going, yes?
Yeah, just a clarifying question. I came a little late.
Yeah.
Is there anything that you're saying here, the label stablecoins, so this is a bank, right?
Yeah, well, the bank would be, so stablecoin providers essentially resemble bunch of financial
Why don't you just call this a theory of banking?
It's kind of different,
Yeah, how? Yeah.
So it's kind of different in the sense, for instance, bank, you would associate stablecoins with deposits. You can redeem deposits at par by law,
Yeah.
but you cannot redeem necessarily your stablecoin at par.
Well, the old free banks, for example, would choose the par redemption rate or
The
discount.
free banking era would be very similar to that. I guess that,
Okay.
yeah.
But again, the bank. It's a bank.
Then you could interpret the theory of banking.
No,
with
I
additional
prefer
traders,
interpreting
yeah.
it as a bank. I don't know why we need this new language.
Then we should regulate, yeah. I mean, there's, I will try to convince you during the talk that it looks a little bit different than a bank, but very well taken, yeah. So let me come back. So we have a virtuous cycle when C is large, the excess reserves are large. We have a vicious cycle when the excess reserves are low. Under these circumstances, there's lots of price volatility, low demand for the stablecoins, and in particular also low revenues for the stablecoin issuer, which reduces the growth rate of the issuer's reserves and further exacerbates instability. As a result, we obtain a so-called instability trap. What does that mean? Stability persists for a very long time. But once the stablecoin breaks the buck, the price falls below the peg, and there is price volatility, then we are stuck in this instability regime, and it takes a very long time to recover back to the stability regime, or this never happens.
So if it's not a bank, would it be a money market?
Money market mutual fund would be the other analog. So like it's always, these are the two financial intermediaries that would be most similar to a stablecoin issue. I think I mentioned the term break the buck, and that like rings the bell at everyone that I'm talking here about money market mutual fund. They would be also similar to that.
There's no legal obligation for money market funds, right, to be on par, right? No.
No direct. I'm not an expert in money market
Yeah.
fund.
If you look the statutes, you're just entitled to the assets. That's it.
Yes. Yeah.
Huh?
They can be principal protected sometimes.
Who can protect it?
They can be principal protected sometimes.
But not by law. I mean, there's no legal, so that's.
Okay. So yeah.
I mean, there's a bit of an issue. But
Yes. So like they are regulated. Let me talk about regulation when we are already here. So like regulation of a stablecoin takes essentially a very central part currently in policy discussions. To give you two examples, like there was the US Treasury releasing a report on stablecoins. There was the US Senate holding a hearing on stablecoins. President Biden signed an executive order on digital assets. All these things happened within the last year. And most recently, we have seen the drastic failure of a relatively large algorithmic stablecoin, Terra, which has also called, essentially casted doubt on the viability of these stablecoins and has called regulators to undertake something. And probably they're undertaking something very soon. So we use our model essentially to assess certain regulatory proposals for stablecoin issuers and stablecoins in particular. What we find is that essentially the reserve or capital requirements for the issuer are most beneficial, and that would be quite similar to a banking type of regulation. However, something different, and which would be pretty much different to banks, is like it might be optimal to allow some debasement of the stablecoin for the greater benefit, essentially, to preclude runs. In particular, when there's no deposit insurance, like there's no, your stablecoin holdings are not insured, you might actually allow the issuer some flexibility to debase the price and to essentially let the price float under times of distress. We also find some so-called volatility paradox. You might be tempted to regulate stablecoin issuers by essentially restricting the riskiness of their reserves. Might work under some circumstances, but under other circumstances, it can actually reduce the price stability. Why does this volatility paradox arise? Well, essentially, if you require the issuer to hold safer reserves, the issuer becomes more bold and holds simply less reserves, which would be kind of Lucas' critique argument. So the whole system might be essentially become more unstable. And in general, stablecoins are, this is like a bit outside of the model, stablecoin initiatives are widely heterogeneous, many different initiatives, many good initiatives that do not look like banks, and there cannot be a one-size-fits-all solution. You might regulate Tether in one way, but the same regulation could not apply to DAI because it's a completely different system. So to come back to David's question, Tether in that regard would resemble kind of a bank, whereas DAI, the stablecoin DAI, would not. It's a completely different system. Yeah, thanks.
But is this theory going to apply to collateralized stablecoins, or is it going to apply to algorithmic stablecoins?
Algorithmic stablecoins are in some sense collateralized as well, but they have just less and riskier collateral, so it applies kind of to these as well. But like, in case of Terra, like, I mean, you're going a bit outside of the model, obviously. They were kind of collateralized they were under collateralized. They had like a small reserve, and then they had their own token, which also you could count as a benevolently as type of collateral, I would say.
Yeah, although I'm not sure exactly what the legal commitment is of the use of that reserve fund in cases of these algorithmic stablecoins, but
Yeah,
okay.
so like the issuer conducts open market operations, you don't have any legal claim on this collateral, so that's important to mention. So you cannot sue them to essentially satisfy your redemption. Okay, let me go into the model. So essentially, we've developed here a dynamic continuous time model, and there's an infinite horizon. There's a continuum of users who derive some convenience yield from holding stablecoins, and they buy stablecoins from a stablecoin issue, and everyone in this model discounts at some constant rate R. And the price of the stablecoin, which I also refer to as the token price, follows the dynamics in one. So it essentially has some endogenous drift and some endogenous volatility sigma p. And keep in mind here, or note here, that sigma p might not necessarily be 0. So when the stablecoin is unstable, this term will be different than 0. When the stablecoin is stable and is at its peg, this term will be equal to 0. And that's an endogenous model outcome. And we have some uncertainty. So there's some shocks to the issuer's reserves. So to answer to Bruno's point, reserves are risky, otherwise the model would not be interesting. Or not as interesting, maybe. The users can trade these tokens at price PT. They can also trade the tokens against the platform. The platform is the stablecoin issuer. And in fact, trading against the platform, they essentially can also redeem the tokens at price PT. So you can think of this as the redemption price. So you can, yes?
One question on the modeling methodology. So this process is of the stablecoin or of the underlying?
That's the stablecoin. That's the stablecoin price.
Okay, because I was thinking about, I mean, if I were to think about this, maybe some kind of, I would have the Brownian motion for the underlying asset and maybe a mean reversion for the stablecoin, because if it's supposed to be stable, something that
Sorry.
is. Okay.
It can be
Yeah, something
endogenously
that's-
mean reverting. Yeah. That
Ah,
can happen.
okay.
Yeah.
Okay.
So like, let's practically speaking, if a stablecoin drops below 1 and you are a big buyer and you think it mean reverts, you would buy. You would be arbitrageur
Yeah.
driving up the price back again.
Okay, so all of
Like,
this
you would
maybe
be happy
we'll
if,
see.
like, yeah.
Okay.
So how am I going on time?
Yeah, still, you still have plenty of time.
Okay, thank you so much. So the supply of the stablecoin as well as the price are endogenous, and in particular, how does the stablecoin issuer control the supply? How does the stablecoin issuer control the price? Essentially, the stablecoin issuer acts as a central bank here and conducts some open market operations in a sense that the stablecoin issuer can mint new tokens, in which case the supply S expands, or the stablecoin issuer can essentially buy back tokens or burn tokens in crypto terms, in which case the supply of the stablecoin contracts and S decreases. So we're assuming here that stablecoins are in one way useful, very reduced form in the model. Stablecoins offer a convenience yield, and that's why they are bought by users. And to motivate some stability preference, essentially we assume that this convenience yield decreases with the price volatility. So stablecoin is only useful for you if it's really stable. Once it becomes unstable, you don't like the stablecoin anymore because it defeats the purpose, kind of. So the convenience yield of the stablecoin decreases with the volatility of the stablecoin price, and it also decreases with the fees that are charged by the platform. And then we get some here stipulated demand for the stablecoin, which is microphone in the paper. The demand for the stablecoin is denoted N, and that's in dollar or numeraire units. And all you need to know on this slide is that the demand for the stablecoins decreases with the price volatility. So to repeat, if the price dips below the peg and the price has some volatile movements, then the stablecoin demand, all else equal, will go down. And now, this is the last slide of the modeling. Now we look at the platform or the stablecoin issuer. The stablecoin issuer holds some reserves, denoted empty, and these reserves are used to conduct open market operations to stabilize the price. And let us look at the stablecoin issuer's earnings or reserves. So stablecoin issuers' reserves grow with the interest earnings. So there's some yield on stablecoin reserves, which for simplicity are equal to the interest rate. They grow also with the proceeds from issuing or selling new stablecoins. They grow with potential fee revenues, because the stablecoin issuer charges users some fee FT. They are exposed to some uncertainty, capturing that reserve assets are risky. So, or it could be also other sources of risk. You could think of operational risks. And at some point, the stablecoin issuer pays out dividends to itself.
What is N?
N is the stablecoin demand, which is also the stablecoin supply by market clearing there. So it's the total amount of stablecoin outstanding in terms of the numeraire unit. So you might think maybe the shocks should scale a bit differently. It doesn't really matter in the model. Like one could essentially modify it. Yeah.
That the shock that being proportional to N.
Yes. Yeah. So like we have that also in the paper. Might be more natural in some circumstances. Yeah. Wouldn't change the result. So yeah.
I wouldn't call this an open market operation, right? And an open market operation. I mean, it's an exchange rate intervention.
Yes.
Right? I mean, this is the central bank intervening in the exchange rate
Yes.
market for its own currency.
Yeah. Yes. So like you could interpret it in two ways. So one
And
way would
you can
be,
think of MT, I mean, I don't know, it's the dollar holdings of the Turkish central bank trying to stabilize the Turkish lira, right? I mean, that would
yes,
be
yeah,
like
that
that.
would.
So.
The dividend is to the stablecoin issuer. So the stablecoin issuer maximizes its profit. So like essentially, the stablecoin issuer maximizes it, which is the expected sum of its future dividends. So essentially, the stablecoin issuer maximizes its equity value
Where does the dividend come from? Is it earning
from the
money?
reserves. So essentially, the game goes like follows: you're issuing a stablecoin, you're holding reserves, and you can decide what you want to do with your reserves. One way would be you keep the reserves, maybe to foster stability. Another way would be pay out the reserves to yourself. In particular, I mean, very extreme, you could think of pay out the reserves to run away.
So there's some constraints on the maximization problem.
Yeah, so like they wouldn't like to do that, but yeah, so it will be optimally determined when to pay out dividends. So you're trading off, do I keep a dollar and keep the stablecoin a little bit more stable, or do I pay out a dollar? So that's what you always do.
Tell us the constraints?
I tell you all the constraints that would apply to this model, yeah. Okay, so let me quickly wrap up the slide. So the stablecoin issuer holds some reserves. These reserves grow with interest earnings. They grow with fee earnings. They are risky in a sense that they are exposed to this Brownian exogenous shock. And the stablecoin issuer decides when to pay out dividends to itself. Dividend payouts have to be positive in the sense that the stablecoin issuer is protected by limited liability and you cannot raise new funds without friction. Yeah.
Some stablecoins, the way they maintain their peg is by burning coins.
Right.
So N would be correlated with the price.
Yes.
Endogenously, you get
That's
that?
right, yeah.
You have that in the model?
Yeah. So maybe on the next slide it will be clear. There will
Okay.
be some market clearing essentially.
Okay. Okay.
And the last thing is, what does the stablecoin issuer maximize? The stablecoin issuer maximizes its own profits, its own equity value, which is the expected discounted sum, essentially, of dividend payouts. And there is some different discount rate to preclude that the stablecoin issuer accumulates essentially reserves forever. And what does the stablecoin issuer essentially control? Where the stablecoin issuer decides on its dividends, it decides on essentially the token supply via these exchange rate interventions or open market operations, and it decides on the fees, FT, it charges to the users. Yes?
Yes, you can interpret this as an entity trying to maximize its senior return.
That's right, yeah.
So that's just the way.
Yes. You can, that's a very good way to put it, yeah.
You're too slow. No,
Question
I'll just keep this.
terminated, question finished, or like... Okay, yeah, thank you very much for all these questions. So let me go on the, essentially, equilibrium slide. So this answers Julian's question. In equilibrium, the demand for stablecoins in dollars, which is NT, has to equal the outstanding supply of stablecoins in dollars. So what's the outstanding supply? Well, we have ST units of stablecoins and they have price PT. And the demand for dollars, stablecoins is essentially NT, and market clearing condition 2 essentially has to hold. So if to solve the problem, we essentially have to keep track of some state variables because it's dynamic. And the state variables in this model are essentially the platform assets or the platform reserves, empty, as well as the essentially supply of stablecoins or the supply of stablecoins in dollars, ST times PT. And what we show is essentially that essentially the whole equilibrium can be summarized by one single state variable, which we term excess reserves. In particular, these excess reserves are the difference between the platform's reserve assets empty and the platform liabilities, i.e. stablecoins, ST times PT. And that's all in dollar or numeraire terms, yes?
You're saying model solution, but you haven't described the model. I mean...
This is the equilibrium condition, yeah.
And, I mean, go back one slide.
Oh, yeah. Mm-hmm.
I asked for this before. You have a maximization problem where somebody maximizes dividends.
Yes.
Okay. So pay off all the assets to yourself. What's wrong with that policy? Okay, there must be some constraints. Mm-hmm. So the model at this point is incomplete, right? I mean, you're sort of saying, oh, maybe they're trying to keep things stable or whatever.
If you want, I think I can try to answer.
Okay, so like I'm happy to take the help from the audience.
Okay, so I think there are maybe two ways to frame the model. One would be to say, at time zero, we commit to a policy. Maybe that's something they could do with the algorithm. Or another way to think about the model is to say, at each point in time,
yes,
they decide their actions and they cannot commit to them. And in the
That's issue 2, right?
yeah. In the latter case, I think that what happens, the trade-off is the following. If I immediately liquidate, it's good because I can run with the cash. But if I leave the stuff in operation, I can benefit from the future seniorage that reflects the convenience yield that the investors are deriving from holding the currency. And so we have this trade-off, which is like a traditional trade-off in corporate finance, in models like Leland and things like that.
That's correct. Yeah, so like Bruno's questions pretty much, Bruno's answer essentially pretty much answers the question. I at least hope that Harald is satisfied with that, yeah. So essentially, we're solving for equilibrium where everything can be characterized in terms of the state variable excess reserves. And the state variable essentially has some very natural interpretation, and you can actually calculate this for stablecoin initiatives in practice. So what does this excess reserve represent? Well, if these excess reserves are positive, then the stablecoin is over-collateralized. What does over-collateralized means? Well, you have more reserves than stablecoins outstanding. So even if there's a run, or even if there's a speculative attack on your stablecoin, you have sufficient reserves to essentially defend the exchange rate. Things are different when the excess reserves are negative. In that case, the stablecoin is under-collateralized. What does under-collateralized mean? Well, if you're under-collateralized, you have less reserves than stablecoins outstanding. So that means the stablecoin is prone to a run or speculative attack. Particularly if everyone were to sell the stablecoin, you don't have enough reserves to essentially stabilize the price. And that can cause the failure of the stablecoin. And actually, under-collateralized stablecoins have failed in the past. In particular, Terra has failed. Terra had some reserves. They were not sufficient. In particular, Terra was under-collateralized. So a run or a speculative attack could happen, causing the failure.
I don't think the model captures Terra.
It doesn't capture Terra in all the details, but it was Terra was under-collateralized, which made it prone to this failure we have observed. Yeah. Well, and Bitcoin. They had a Bitcoin.
Yeah, but that's the point. It was self-collateralized, so that's very specific, I think.
That's very specific. Then it's even worse than that.
Yes, it's true. It's
Yeah.
much worse.
Yeah, it's even worse than that. Like, so what we do in this model essentially, we show or we implement the stablecoin system as run-proof. In a sense, what we assume is essentially, let's assume the worst-case scenario, that once the stablecoin becomes prone to a run and the stablecoin becomes under-collateralized, it would be liquidated. And the stablecoin issuer does everything to prevent this. So we essentially suggest a run-proof stable asset or stablecoin creation. And we could relax this assumption, but essentially it's nice to focus on something run-proof, given that we have seen that these runs are essentially a major cause of instability. So I cannot go to the whole solution, but let me show you the results. I know it might be dissatisfying for some people, unsatisfying for some people, but unfortunately I run out of time. The result is as follows. Even though there's no run, there is price, volatility, and instability. In particular, as the panel A essentially shows, the price volatility of the stablecoin is 0 when the stablecoin issuer has sufficient reserves or excess reserves. Price volatility 0, sigma p to 0, means essentially the stablecoin remains at its peg. However, when there are negative shocks to the stablecoin issuer's reserves, and these reserves are depleted and fall below some critical threshold, this dashed red line in panel A, then price volatility rises. In particular, this price volatility spikes once the stablecoin reserves fall and fall and fall. So like essentially we're getting some pretty much instability here. When the stablecoin is unstable, which is like when the reserves C are low, then there is also low usage or demand, which essentially panel A shows here. I would like to maybe also then show how the price would look. Consistent with what I said previously, the price is stable when the issuer's reserves are sufficiently high, and under these circumstances, the stablecoin maintains a hard peg. Once the stablecoin issuer's reserves fall again below this critical threshold, the price falls below the peg, there is price volatility, and essentially the stablecoin issuer maintains a soft peg to the stablecoin. The peg is partially resolved. And you can interpret this as a targeted price band. Let me just look at the dynamics, and this is the conclusion.
Can I ask just one quick question?
Yeah.
I'm trying to understand what what is meant by a run in this context. So there's not individual choice by token holders, right? This is some kind of, what is a run in this
A run
context?
would be essentially that everyone sells it, like the worst run.
No, but we didn't model a decision of token holders. So I don't.
Because there is also no reason to run in this model because we are over collateralized. So like we could satisfy every redemption request.
But in the other case.
No, okay. I mean, I'm just saying, I didn't see any discussion of what the preferences are of token holders and what would determine whether or not they would choose to run or not.
They optimally wouldn't choose to run in this model.
No, but how do I know that? I didn't.
To complement Rod's, I agree with Rod. I think what you have in the model is you have a demand function,
Yes.
the N, and that's what determines how much they want to hold. And I think, I agree with Rod, that does not include a run component.
We are staying away from runs. There's also no motive for a run because you could satisfy every redemption request. It wouldn't be like a diamond dipwick where you have like essentially.
Okay, but I thought on the previous slide you said something about creating
it's
a run.
run proof. That's what we're focusing on. We essentially.
Because there's no motive for runs, so therefore it's run proof.
This one is run proof essentially.
Okay.
There won't be a run in equilibrium in that sense.
But just
So
quickly, I'm
let me
sorry.
conclude essentially with okay.
What about the previous case when it wasn't run proof? Well, now it's under collateralized, and Rod's question applies again. Where are the decisions being made, if any? If it's just reduced form, or are you assuming a run occurs just because it's under collateralized?
A run, this would be the assumption underlying the baseline model. You could always assume, like, let's say, a run occurs when the reserves are sufficiently
Right.
low.
So that answers Rod's question. So just
okay. So like maybe we can chat afterwards. I would like to conclude essentially with this slide illustrating the model dynamics. It essentially illustrates this instability trap. The price is stable for a very long time, and this is some simulation, without any hint of instability. But at some point, essentially, these reserves dip very low because there's negative shocks, and as a result, the price dips below the peg 1. And then there's a price volatility, and that price volatility persists for a very long time. And in this example, it takes about 5 periods essentially to recover again back to the fixed exchange rate regime. More formally, the distribution of states is essentially bimodal. We have a large probability mass in the instability regime here, and we have a large probability mass in the stability regime. In other words, we have an instability trap. Thank you so much for your attention. Essentially, I would like to conclude maybe with the last slide, but I have already said everything. We develop a dynamic model for stablecoins. There's some implications for regulation, for implementation in practice, and we also have other applications we discussed. Thank you so much.
Okay, now so we have 5 minutes for question, and at this point I would like to start with the first. I think your model it's a very general framework, and I have the impression that it has many potential choice variable of the stablecoin designer. So at this point, I was wondering, thinking about the Terra Luna case, how you would incorporate, for example, the case where the designer can control the token base to stabilize the price. And in that model, you would do it by basically endogenizing the variable that is P. I think that is so you let the amount of token, I don't remember exactly the notation that you use, but I think it's S.
Supply, yeah.
S. So maybe, would that be the case that if you let S become a choice variable of the designer,
Yes.
then you would be able to study kind of Terra Luna stablecoins?
Yes, so very good point. Like essentially S is a choice variable in the model. I didn't come to this. Essentially the stablecoin issuer controls implicitly or explicitly, as you wish, the stablecoin supply. In the most explicit form, the stablecoin issuer would conduct open market operations or exchange rate interventions. More implicitly, the stablecoin issuer could also charge an appropriate fee for holding stablecoins and such, which then motivates users to redeem or to mint new stablecoins. A simple answer, yeah, the stablecoin issuer controls that, and like essentially tries to maintain price stability, but when it essentially runs out of reserves, it's no longer able to essentially maintain price stability. Yeah.
I also have a question.
Sure.
Is the riskiness of the reserve asset chosen, or is it exogenous?
Yeah.
If it is chosen, what drives this choice?
Yeah.
And where do we see that there would be a benefit, a value from holding risky reserves as opposed to safe reserves?
Okay, so that's a very good point. So maybe, sorry for answering with the slides, but essentially the slides are here. Okay, so first of all, they are in some sense exogenous, subject to scaling. So when you scale up the stablecoin, then everything becomes more risky, but you also become larger. But essentially the base risk of the reserves could be seen as exogenous. Then you could ask the question, why hold risky reserves in the first place? And then we have like some small extension. And here essentially you see the reserves and there's this red term. And let's say you could essentially increase your risk for more returns. So like you would have a risk-return trade-off. In practice, how would you choose it? I guess there is some benefit of like taking.
Why wouldn't something like a Modigliani and Miller result? Because holding risky assets is something that the investors can do themselves. And why would the stablecoin issuer have a special ability to hold risky assets that the others wouldn't have?
Oh, I see. So like that's a very deep question. Banking question, yeah. Well, I mean, I would have to answer, but otherwise, the only answer I could think of, like, I mean, somewhat the stablecoin issuer is like the only one able to would like to transform these risky assets into safe ones, given that there's some demand. I don't know why it wouldn't be couldn't be solved with some like direct market solution.
I have a question.
Oh, sure.
So first of all,
Okay.
thank you for sharing your paper. And I want to know, you mentioned a particular case about over-collateralization where the total value of assets held are larger than the number
Yes.
of stablecoin in supply. But as a rational issuer of the stablecoin, why would I have that case? Let us assume I hold a risky asset. If any time my reserves are higher than my supply, I would immediately cash out so that I can have actual dollar reserve for much more safer asset because I know my underlying holding asset is anyway risky. And second question that I have is, you mentioned the case where there is over collateralization and the risk of bank run or the stablecoin run is very low. But usually when we go in a run, it's a herd mentality where everyone is cashing out irrespective of whether a bank or the government can fulfill the holding. So even if you are holding a safe asset as a stablecoin company, just because everyone wants to take out the money at the same time, even if they have safe paper like say US dollar bonds, it would still lead to run over the stablecoin peg and lead to instability within the price movement.
So let me start with the last question, the second one. Well, I mean, when you're over-collateralized, you have sufficient reserves essentially you could in principle push back the price to the peg.
But this is leading to like 2-degree effect. So just because I want to take out all my money, let's say from USDT, USDT is selling the US bond, which in turn is reducing the bond value of US bond. So
that you have some price impact which might fight your,
yes,
or
exactly,
which might
because
essentially.
the stable coins are in such a large quantity, and since the run is in a very short interval, everyone wants to take out their money today. So let's say today $100 billion are supposed to be cashed out of the bond market, and that would.
No, that's a very good point. Like even if you were, let's say, if you're by current prices, you were over collateralized, it might be that once you liquidate, you have a price impact, as you just said, and in fact, you would be under collateralized in case of a liquidation. We do not model this here. You couldn't liquidate your assets without price impact, but I see your point that this is like kind of abstracting from like stablecoins which have a concentrated ownership in a specific asset class. To answer your first question, I guess. You wouldn't like to run away because again you would lose your senior rush revenues. But I'm not sure whether I like missed here some stuff.
So what I'm saying in my first question is that if I know as a stablecoin issuer that my underlying assets are volatile and my access reserve, let's say the Bitcoin price shoots up and my reserves are higher than whatever amount of stablecoin I have issued, won't it be in my best interest to short Bitcoin when I know that the price might fall and keep that money as a reserve for the future.
Short Bitcoin. I have to think about it. Like that's maybe. I think there was one last question here, so like which. But let's talk later. Yeah.
Please. So one thing I have a question about, Simon, and thank you for your presentation, is like the way that you calculate the liabilities of the stablecoin arrangement, because like you multiply the supply of the stablecoin with the price of the stablecoin, but then like what are you really promising in terms of a liability? Because if you promise people to say redeem at par, you would be multiplying with 1 regardless of what the price is, right?
Yeah.
So, and it's kind of closely connected to the question that Rod asked earlier, like what's really the bank run mechanics? Like what would the user do? Like, do they, for example, like once your assets drop below like whatever you're covered with $1, that potentially gives them like an incentive to run, right? Because they get $1 rather than selling. But like, I'm just kind of wondering, I'm just struggling with your idea of your liabilities, and then consequently what excess reserves really mean.
Yeah, so liabilities, indeed, like most, let's say you're in a good regime, you have a peg, and then like liability would be just supply times 1, because the price would be 1. But then essentially the interesting thing what you could do is, like a country essentially monetizing its debt by inflation, you could essentially debase the price. The price goes down, your liabilities shrink, which would be you inflating away your debt. And this would preclude a run, essentially.
Can you explain a little bit more how that would work in practice? Because, like, if Italy, like, if the default risk goes up, it's not that their liabilities go down.
If the price of the stablecoin has to go down, you could control it. Let's say you would mint new stablecoins. You could, I mean, in principle, it's kind, or you could send. You anyhow have to do something. Like, let's say you're only satisfying redemptions at 90 cents instead of $1.
You could buy them back, I guess. That's kind of what you're saying.
Yeah.
Yep.
Maybe let's talk afterwards. I guess. Like.
Okay.
Okay.
Thanks.